Ladies and gentlemen, welcome back to the channel. In today's episode, we're going to be talking about, yes, what happened today in markets a little bit. It seemed like some of the downside pressure subsided a little bit in some areas like Tesla, like some of your higher quality small cap AI stocks. It wasn't as uniformly negative today as it has been recently. Some of the slowing, aka slowed down. Now, in today's episode, we're going to do a couple of things. Number one, we're going to share what Tom Lee said today about this market and what Dan Ives said about this market. Both of them basically calling for a year-end rally. And I know it's going to sound crazy, but that seems like the most likely outcome at this point. Now, if that happens, and we'll talk about what needs to happen to get a year-end rally, what does it likely do for Tesla? You know, are you still looking at a Tesla stock that could be a $600 stock by late, this year, by early next year? What needs to happen to get the stock substantially higher? Keep in mind, the stock has fallen about 16% in the last 2 weeks or so. So even though it feels like Tesla has done a lot better than a lot of other stocks, you're still down like 16% in the past 2 weeks. So it's still been rough. Okay. Today's recovery was really nice, but it has overall been rough for Tesla, for a lot of areas of this market. So do me a quick favor, ladies and gentlemen, hit that like button as well as subscribe to the channel if you have not done so already. And let's get started. So first and foremost, what happened today? There was a couple smaller pieces of news, but I would say the biggest thing is we are going to get some of the economic data that we were supposed to get when the government was shut down. It looks like we're going to get the September, I believe it's October actually, the CPI report. Okay, we're going to be getting retail sales, consumer spending, and maybe the jobs report on October 26th. Okay. Caroline Levitt yesterday said that, basically we might never get the CPI or October jobs report. And that just read funky. Okay. People are like, okay, was it so bad that you just don't want to release it? Come to find out, it seems like there was a real issue getting the data processed. Okay. The data was collected, but not processed. So now the BLS is going through and trying to process this data, get it right, and get it ready to be released. Neither here or there. It does, not crush, but it eats away at some of the bear narrative. Why? Because it's pretty easy to short a market where there's so much uncertainty because the government's shut down. You're not going to be getting economic data. It becomes a little harder once you start to get the data, right? Because just not having the data is bearish in and of itself. But once you start to get that data, then people can start to come to logical conclusions around this market. Everyone has their own opinion right now on how things are going in the economy. But once you start to get that data, you start to, kind of have an understanding of where things are at. And Wall Street has really just ran away with, how bearish they are right now. Okay. Wall Street thinks the economy is in a rough place. Wall Street's looking at the Fed, and the Fed's saying, hey, things are fine. We're not really too worried about cutting rates. It's like, who is right and who is wrong? If the Fed is correct that the economy is not that bad, then fine. We don't need rate cuts. Stocks can do well regardless. If, Wall Street's correct and the economy is in a rough place, then it introduces more rate cuts. But until there's any kind of certainty on where things are at, it's up to individual interpretation on, what's going on. And the best Wall Street has right now is they think the economy is weakening and they think the Fed is not going to accommodate things, aka getting closer to a policy error. That's why it's been pretty easy to understand why Wall Street has been bearish this whole time. Now, I am under the impression that the economy is probably not as bad as feared. Now, the fears have been incredible. You know, the NASDAQ was down 6%, S&P was down about 4%, small caps were down 8% at the high, you know, at the lowest point. And a lot of your smaller cap AI companies, unprofitable companies, are down 50% in the last 3 months. Okay, that's not uncommon to see right now. Which, when you're that bearish, it takes a lot of bad news to get stocks to continue the selling. Now, for Tesla stock specifically, the stock has held up a lot better than obviously some of those other areas, but Tesla stock has started to get dinged as well in the last 2 weeks or so. It was down about 16%, but there is reason to believe, like Tom Lee and Dan Ives are going to tell you in this video, that things are about to get better from here. Again, simply put, when people are this fearful, usually that fear is misplaced. Like, Wall Street has been pricing in a recession now for 6, 7, 8 weeks, better part of 2 months. And if those recession fears do not start to materialize, then you're going to see a rebound in this market. And getting the economic data is the first step towards seeing where the economy is at. Okay, and the little bit of a recovery you had in some of those most beaten down areas today is reflective that just getting the economic data in and of itself is a positive. Now, still, again, November and December are very seasonally good months. People have a lot of fears right now about the AI trade and how companies are financing it, blah, blah, blah. We're going to hear from NVIDIA, you know, in about 2 weeks, and they're going to tell us that things are great out there, that things are just fine. There was a bunch of price target increases on NVIDIA today alone, aka the AI trade is not going away anytime soon. We're going to hear from Walmart and Target next week, and they're likely to tell us, yeah, things are not great, but they're not terrible either. And that is also going to serve as a very positive catalyst for this market. Now, first things first, I want to share this clip with you from CNBC today and from Fundstrat and Tom Lee, where it's titled, "Tech Pullback is Normal, but AI Productivity Boom Still Drives the Rally." So take a listen.
Talked a lot over the course of the last several quarters and maybe even multiple years now about the secular bull run in technology. Is it over?
I think we should expect from time to time profit taking, because tech has been a leader for the last decade, and it is overbought. So I think it is going to be from time to time going to show extended weakness. But to me, the underlying story driving technology, which is the productivity miracle coming from AI, is still intact. Mary Erdos even talked about this earlier this week from JP Morgan, that there's been a payoff in spending, and Lisa Su at AMD as well as noting that productivity lift is the reason AI spending is rising. That's actually still a tailwind for tech stocks.
Tom, if I could just follow up, you manage funds now, especially an ETF that's heavily tilted in some ways towards some parts of that kind of technology, media, and telecom trade. Has anything changed with regard to the price action or the fundamentals that have taken some of those names perhaps out of your portfolios?
Dom, we just actually did a rebalance for the Granny Shots ETF, our large cap fund. We still actually have about 40% exposure to tech. It's about a market weight, but to us, the visibility and the spending is still very strong, and names like NVIDIA are still reasonably priced. I mean, NVIDIA at 28 times forward earnings is still less expensive than buying Walmart or Costco. Costco is almost 50 times forward earnings.
All right, Ross, with that in mind, as you watch the price action play out, does it surprise you at all that we've seen this kind of a sell-off? Could we expect more of this in the coming weeks?
I don't know if we'll get more of it, but investors should expect more of it. I mean, if you look even at the late 90s, during the heyday of the dot-com bubble, 96 double-digit sell-off, 97 double-digit sell-off in the NASDAQ, 98 big sell-off on LTCM and some other weakness, and then 99 even big sell-off in the NASDAQ. So double-digit sell-offs even in bull markets driven by new technologies and exciting new technologies are really common. And this one, is just par for the course, I think, amid a broader bull market. So as long as the technicals and the underlying trend isn't too damaged, I think it is a dip you can buy. But I think investors should always expect a little bit more weakness. We've been on a tremendous run off the April lows. That kind of momentum can't sustain forever.
Ross, do you feel as though there is any kind of a case to be made for a possible rotation trade? We've been exploring the possibility that maybe this broadening out could include less AI and tech and more things like perhaps energy or financials, something else along those lines. Does that thesis play out in the coming quarters in your mind?
Sure. And I think it's incredibly healthy that as AI is pulling back, we're getting some nascent leadership from things like energy. Healthcare has had a tremendous month thus far after being really beaten up for a couple of years. Financials, big banks, both in the US and globally, have held up solidly. So, obviously the headline indexes are going to be weighed if big tech sells off. But I think it's incredibly healthy both on the earnings front and on the price front that you're seeing some breadth, especially at a time when the question about the broader economy outside of AI is how healthy is it, right? So this is a really good sign to me, and I'm happy to take a little bit of gains from tech and rotate into some nascent leadership there in other sectors.
Tom, the tariff tantrum issues aside from earlier this spring, specifically in April, we haven't really seen any kind of a pullback last that long. It seems like these things are getting shallower, they're getting shorter in duration. If it is the case here, does it still play out that way? And if so, what exactly then goes on shopping lists? I mean, you mentioned your ETF GRNY, Granny Shots. Is there anything that you would be thinking about buying more of? I know that the rebalance is already there, but what kind of stocks actually go and you want to buy on discount here heading to the year end?
Yeah, well, I think it is helpful to think about where we are in the cycle. I know the Fed is a little hesitant the reason to cut in December, but the reason they're hesitant to cut is the economy is actually pretty healthy, and they just don't have a clear contour of how quickly inflation's cooling. That's a very good backdrop for corporate earnings, actually even corporate earnings to actually start to spread. So if the Fed gives us some guidance and visibility about, path forward, I do think business confidence picks up. That means that ISM starts to recover, and it is a broadening trade. So I would agree with the other speaker that, I like tech structurally because of AI spending, but there's still plenty of room for the small caps to work, which have really taken it in the gut as the Fed's sounded hawkish, and the banks. And so I'd be in sort of favor of a broadening trade as well. But I still like tech. And as you know, the AI trade comes under question every few months. There's always a big pullback, but for the last 5 years, investors have had to buy that pullback.
Ross, we'll give you the final word here. Does the Fed need to cut rates in December for this market rally to keep going?
They don't need to cut rates to keep the rally going. I think they should cut rates. I think there's enough labor market weakness and there's not enough upside pressure from inflation that they should be at least getting to their neutral policy stance with some haste. I don't think there's any reason to pause. We don't have any data, so I don't know what has caused the hawkish turn. Obviously, the underlying economy is not in recession. It's fairly healthy, but we're in a restrictive stance. I think we could get to a neutral policy and then go from there. I don't think they need to cut. I just think they should.
All right, I lied because, Tom, I'm going to give you the last word. I want to hear what you think. Does the Fed need to cut rates for this rally to continue?
I think from a market's perspective and from the economy's perspective, we know that high rates are actually causing pressure on the housing market. That is, something that I think the Fed actually has some, can actually have some impact on. So I do think it makes sense for the Fed to cut.
Take a listen to what Dav Ives says. He says, quote, "It's time to buy the dip ahead of the year-end tech rally."
Securities head of technology research, Dav Ives, joins us now. Dan, I don't think it's surprising for people to hear you pound the table on the tech trade. You've been super bullish. Do you not have concerns now about monetary policy, as the market rethinks the cut for December and the overall frothiness or valuations around AI?
Yeah, look, Sarah, I get some of the nervousness, but I was just in Egypt for 3 weeks. And demand to supply for NVIDIA chips are 10 to 1. Demand's increased, call about 30% since June from what we see. You look at hyperscaler, this is a CapEx supercycle. So it's my view, if you're in the second, third inning, to be sort of bearish or nervous here, I just view it as short-sighted because I think there's a tech bull market that goes on for another 2 years. And I think these are golden buying opportunities for the names that I view where streets underestimating numbers 20, 30% over the next 12 to 18 months.
But do you think there will be a point where the capex should get more scrutinized, or, until the profitability materializes to match the level of spending?
Sure, and look, and I get the scrutiny. Like if you look, obviously, Meta and Oracle, and you see some of the worries there, the circular financing in terms of OpenAI. But to me, it's all about you're building out a new economy on the consumer, on the enterprise front. For every dollar they put on CapEx, they're going to ultimately make $8 to $10 on that over the coming years. So I just think that is the best move for these companies in the arms race. And that's why for Meta, I've talked about that's a table pounder on that stock in the sell-off. Oracle, same thing. And, so many times we've talked about in your show, like these are the opportunities, whether it's DeepSeek or other moments, and then investors are like, I missed it, but these will be the opportunities. I think you're going to have a massive tech rally into year end.
Dan, Oracle's a great example. What explains that early September gap getting filled as we are back to the 200-day here for the first time since June?
Yeah, Carl, I think it's just worries about debt, taking on financing, CapEx, the depreciation, the OpenAI pop. Like, did they get over their skis? And actually, I disagree. I think Oracle, this is a massive renaissance that they're going to see. I mean, you talk about they're 2% penetrated within their install base when it comes to AI. Everything they're doing are the right moves. And I think this sell-off here, we're going to look back 3, 6, 9 months from now, and this was just, I think, a golden buying opportunity on Oracle. And I think right now the nervousness is coming out, but it just comes back to 3% of U.S. enterprises have gone down the AI path. And I think that goes to 20% over the next 18, 24 months. That's what you're playing for, especially in the second, third, fourth derivatives. We see it, cybersecurity. Right. I see human proof authentication. I see it on, infrastructure, Nebusis, CoreWeave, and others.
Does that view extend to Tesla, which, as we said earlier this morning, is now red for the year and worst performing Mag 7?
I think actually Tesla is probably, of all of these names, that's probably the one to me that sticks out the most. Because in my opinion, the future about autonomous and robotics, Musk, obviously right now, wartime CEO. You look at the coming years, I think Tesla's a $2 trillion and ultimately a $3 trillion market cap because autonomous, 80% of autonomous, I think Tesla's going to own. So I get the stock selling off here because you can't see it in the numbers. But I mean, this is something where I look out 600's base case, 800's bull case. And Carl, that's my view. I mean, I think this is only, like I talked about, this is just the early days of a fourth industrial revolution. And for the first time in 30 years, the U.S. is ahead of China when it comes to tech.
Yeah, I mean, that's the bull case, Dan. So aren't there going to be winners and losers? It sounds like you like all of the big players.
Yeah, and Sarah, there's going to be losers. I mean, if you look at Adobe, are they a loser? If you look at, some of the other sort of large cap names, like they're trying to sort of, I mean, I think Salesforce, is going to be a winner, but they're obviously under a lot of pressure from a software perspective. You look at some of the infrastructure plays like a Cisco, they're turning it around. I think it's really more about the second, third, fourth derivatives in software. I look at names like Nebius. I look at names like CoreWeave and the sell-off because it's all, to me, about for every dollar, and this is the most important stat, for every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across the rest of tech. $3 trillion that's going to be spent in the next 2 years.
Right. But you, in your view, it's all the hyperscalers that are the winners, the Amazons, the Googles, the Microsoft. Meta, you said, is a table pounder. So everybody that's spending big now.
Well, I view it as, if they're not spending, I actually view it as a negative. Like if Meta ultimately pulled back and they raise numbers for next year and they cut CapEx, I would view that as a huge negative because Zuckerberg right now, wartime CEO, building out what could be monetization, an incremental 40, 50% on advertising, on the consumer side, and even as they build out on the glasses and on the hardware side. That's the smart move for Meta. I also look at names like when you think about, we've talked about in the power side, nuclear, names like ACO and others. I mean, this all is about the second, third, fourth derivatives. People think that this is sort of a white knuckle, clock strikes midnight moment. I've talked about it. This is nowhere near a bubble. It's a 1996 moment, not a 1999, 2000 bubble moment.
Is there any demarcation line between names you would like and not like? Oklo's a great example where you're either talking about no profits or in some cases, in quantum, for example, minimal revenue.
Sure. Yeah, and Gar, I think that's where you have to be selective in terms of like the winners and who ultimately is going to be there. I think there's going to be other nuclear plays, right? There's going to be other power plays out there. If I see the demand is showing cracks and I see customers cutting back, the ROI is not there, use cases aren't exploding, then we get negative. But to some extent, it's the opposite if you look at where we are right now. And I just think like globally, given where U.S. tech is, this continues to be what you want to own. And I think for the winners, and look, if you focus just on valuation, 1 year out, 2 year out, you missed every transformational tech stock the last 20 years. And that's why I focus on, we talk about in our Ives AI 30, like who are the winners in the different sectors.
Actually liked a lot what Dan Ives had to say here. That sounded pretty logical in a market in which most people are not thinking logically at this point. Now, with that said, what is next for this market? What do you need to see happen? Okay. Number one, government is reopened. That's good. You stop the hemorrhaging of this economy. But number two, how is the economy doing? If the economy is doing great, fine, we don't get rate cuts, but stocks can do very well. If the economy is not doing so well, that's not great for stocks, but we get rate cuts. So either way you really want to put it, just getting the economy open, getting clarity on the economy, either which way is positive. And I think that's what stocks today are kind of growing to expect, a little more certainty around the economy. Nvidia earnings, like 2 weeks from now, okay? That's going to be huge, okay? That's going to likely trigger the tech year-end rally, right? But also Walmart and Target earnings next week, and you actually have quite a bit of earnings still to come. A lot of your smaller companies, your mid-cap companies, and obviously Nvidia. But Walmart, you know, they're going to tell us how the consumer is doing. So even before we get the government data on November 26th, some of the data we missed during the shutdown, Walmart's going to be able to basically tell us, hey, are we in a recession or are we not? How is the consumer doing? Back in 2007, Walmart was one of the first companies to raise the alarm on the economy and on the consumer. Walmart is the most important earnings in terms of judging or, you know, figuring out how the economy is, how the consumer is. And this time around, it's going to be that much more important. But again, I just look at this market that is super bearish, that is terrified, but that fear really comes from the uncertainty, and it looks like that uncertainty, it will be alleviated over the next couple of weeks, and that does likely set us up for a year-end rally. Obviously, as Dan Ives was talking about with Sarah Eyes in there, you do want to be selective, right? You don't want to be in no revenue companies, like you don't want to be in companies that are hemorrhaging cash every quarter. You want to be in stocks that are trading below like peers, right? You want to be selective right now. And that's what we are doing in the trading community. Of course, if you guys want to join us, check that link out down below in the description of today's episode. But I'm excited for what's next in markets. I mean, I think there was a lot of washout. I think a lot of people capitulated, got margin called, and ultimately got, you know, sick of this market, sick of watching stocks fall. And that's usually precisely the bottom. And that could be upon us very soon. In fact, we've, you know, your AI stocks, some of your, you know, lesser quality names are down 50 to 80% in the last 3 months. But even the headline indexes, NASDAQ fell 8% at the high, or 6% at the high or the low. IWM fell about 8% at the low. S&P fell about 4.5% at the low. You basically just seen a correction, but like under the surface, you've seen a crash. And, you know, you got to justify things getting worse from here. AI looks alive and well. Economy, we don't know. Fed, we don't know. But just getting the certainty likely leads to quite a rally with this kind of fear out there in the system. Do me a quick favor and hit that like button, as well as subscribe to the channel. Let me know your thoughts on all of this down below in the comment section. Have a great rest of your day, and I will see you in the next one.